So we are going to talk about the three drivers to extrinsic value for a few minutes. Now, if you think about what we do as premium sellers, right? Like what is our widget? Like what is the thing that we are essentially marketing or selling in the marketplace? It's extrinsic value. Like we're selling options and we're focused on option prices and whatever. But the actual widget, like if you really break it down to the brass tacks, it's going to be the extrinsic value of that option price. Now, what's interesting about the world of options is, when you have these elegant, complex models, these mathematical models that determine option pricing, like a Black-Scholes model or some of the other option pricing models that might be out there that are essentially really, really complex formulas that are built to help us figure out, hey, what should the intrinsic value be? What should the extrinsic value be? Now, intrinsic value is admittedly a very easy calculation. Extrinsic value, on the other hand, is actually very, very complicated, and there's many, many, many different steps. But if you really break it down, and if you really strip it down to the chrome, there's only three factors that are ultimately going to be driving the extrinsic value on any given option. And so that's what I want to focus on here today. We'll do a little bit more in a couple of days, and then we'll do factor number 3 here on Friday of this week. So John, go ahead and get us into the slide here. So what is the first driver? It's going to be time. The first driver of extrinsic value, the first thing that's going to be impacting extrinsic value the most is definitely going to be time. So let's work our way through the information here that we have on the slide. Whenever you're learning anything in the world of finance, anything in the world of the markets, or really, a lot of things just mathematically in general, there's always going to be a mathematical explanation for what's going on, and there's always going to be an intuitive explanation for what's going on. And so this is especially true when it comes to the markets and it comes to trading, thinking about the different positions and like the metrics that we use, whatever it might be. Today, I want to focus almost exclusively on the intuitive side of things, and we'll probably maintain this same type of mantra going forward through this little 3-part series into extrinsic value, because I think it's going to be the easiest to grab onto. I think it's going to allow you to kind of mentally wrap your mind around these 3 factors that are impacting extrinsic value, especially if you're a brand new trader. Like if you're just starting out and this is all brand new to you, my hope is that this information is going to help you kind of expedite your journey across the learning curve. So ceteris paribus, more time always leads to more extrinsic value, right? More time always leads to more extrinsic value. Ceteris paribus, of course, meaning all other things being equal. So if we took everything in the market and we made it all fixed, we made it all static, where nothing is moving and nothing is changing, which of course is never the case, because in the market, on any given day, everything is moving, everything is changing. But if we actually just put everything into a vacuum and just focused on extrinsic value and how it relates to time, what we would see is more time means more extrinsic value. Less time means less extrinsic value. So this is kind of the base case. This is kind of the default setting when it comes to extrinsic value. This is going to be the thing that is going to essentially guide you in your understanding of how time does indeed impact extrinsic value. When it comes to extrinsic value and it comes to time and it comes to this positive relationship, the most important thing, and in fact, this is going to help you, man. This is going to help you in so many ways. It's going to help you today. It's going to help you the next day we do this, and then the last day that we do this. Look at that key on the bottom of the slide. I probably should have led with this. Like if we're truly shooting from strength, I should have gone with this first. Think about an option as a transaction where, it is quite literally a transaction, but think about it as a transaction specifically between the 2 sides of the contract, the long side and the short side. And even more specifically, think about it in terms of the long side buying the contract from the short side. So think about that literal transaction, essentially the way you buy anything else, kind of in this world where you have a buyer and you have a seller. And of course, the buyer pays the seller for the thing. The seller charges the buyer for the thing. It's no different here. This is going to help you immensely when it comes to understanding time and the next factor tomorrow, and then the next factor the following day. So if we think about that relationship between time and extrinsic value and the long side and the short side, when you start to think about how time impacts extrinsic value even more specifically, of course we have more days to expiration. It's going to increase the options price because there's increased extrinsic value. Lower days to expiration, or fewer days to expiration, I should say, is going to decrease the option price because there is less extrinsic value. If you think about the transaction, between the long side and the short side. This is very simple stuff. Like on the surface, you're looking at this like, wow, that's really, really simple. Like very, very simple. It is indeed incredibly simple. But understanding kind of what's happening underneath that surface, understanding kind of what's driving the train here can be really, really helpful. So if we go back to the long side and the short side, who is taking all the risk in any given option contract? Like if you had to say who's taking all the risk, who's taking a lot more risk, let's say, the long side or the short side? Well, it is always going to be the short side. The short side of the option contract is always taking more risk than the long side, and oftentimes multiples in terms of additional risk. Because remember, when you buy an option, whether it's a call or a put, it doesn't matter. The most you can lose is whatever you pay for it. But if you sell an option, now all of a sudden you're essentially exposed to undefined risk. You're essentially exposed to unlimited amounts of risk. So when it comes to any given option, all the risk lies with the short side. Okay, think about time and think about extrinsic value, and the intuitive basis for this relationship, once you understand the long-short relationship, is going to be a lot clearer to you. At least that's my hope. If the short side is taking all the risk and you increase the amount of time on a given option, right? Same stock, same strike price, like everything about the actual trade is the same, but you're comparing, a 14 DTE option versus a 45 DTE option. The 45 DTE option is always going to have a higher price because it has more extrinsic value. Now, why does that always have to be the case? It's very, very simple, right? The short side, the one who's taking all the risk, is essentially communicating to the market, communicating to the potential longs and the potential buyers, hey, if you want to buy this option from me, that's fine, but I'm going to charge you more because now you're asking me to take on all this additional risk for a longer period of time, for 45 days instead of 14 days. And then conversely, it works the other way, right? If you have a 14-day option, or actually, let's use some different numbers. If I have a 10 DTE option versus a 30 DTE option, the 10 DTE option is going to sell for a lot less than the 30 DTE option because, again, the short is basically saying, hey, I don't have to carry risk for as long a period of time, so I don't need to charge you as much, so the option is going to be cheaper. And so when you start thinking about this relationship, just trace it back to the relationship between the long and the short, and I think that will serve you very, very well. The final thing I want to say, especially for us as premium sellers, and then we can kind of conclude today's installment of a deep dive into extrinsic value. When you start thinking about more DTE, meaning higher option price, meaning more extrinsic value, this is going to be something that I think is going to really serve you well at trade entry. So this is going to be something when you're scouting out a trade and you're trying to figure out, what would be a good candidate to put on a strategy, a short vertical spread, a short strangle, whatever it might be. This is going to be something that's going to help guide you in determining, all right, this trade looks better than that trade, or trade A looks better than trade B, or whatever. The second point, the fewer DTEs, lower option price, less extrinsic value, that is essentially what we are doing inside the Tasty universe as premium sellers. Like, this is the basis of what we're doing. We're selling options, right? And then over time, over the duration of the position, obviously the DTE are going to tick lower and lower and lower. And what's going to happen as a result of that? The extrinsic value is going to fall. The extrinsic value is going to dissipate. That's essentially what we're trading. Like, remember, we started today a few minutes ago talking about our widget being extrinsic value, but to go one step further, I mean, that's the thing that we really want to sell up here and buy back down here. Well, what's one of the ways that that's going to happen? Time goes by. Time goes by, extrinsic values fall, and we're able to indeed, cash in from that just natural relationship of the option and of the position over time. So that is a deep dive into the relationship between time and extrinsic value, the first driver of the three drivers that impact extrinsic value. On any given day, it's going to be extrinsic value. Now, yesterday, we uncovered the first driver of extrinsic value, which was time. Today, we're going to uncover the second driver. So, John, go ahead and get us going here on the slide. So the second driver to extrinsic value, I should say, is going to be volatility. And, I would say, at the Tasty Network, this is the thing that really separates us and differentiates us from a lot of other information and resources that you might find elsewhere. It's going to be our dependence on, our, reliance on, our emphasis on volatility as one of the most opportunistic metrics that exists in the marketplace. It's not necessarily like, man, let me get bullish for the next leg higher. Like, let me get bearish for the next leg lower. Like, you can do all those things too. But man, in a market that's really random and quite unpredictable, volatility seems to present us with the most opportunity. So, to take some time and understand, hey, how does volatility drive extrinsic value? I think this will be a useful and fruitful, 3, 4, maybe 19 minutes of our time here together. So the relationship between volatility and extrinsic value is going to be very similar to the relationship that we saw yesterday with time and extrinsic value. In other words, ceteris paribus, more volatility is always going to lead to more extrinsic value. It is going to also have a positive relationship. They are going to move together. When implied volatility goes up, extrinsic value is going to go up. When implied volatility goes down, extrinsic value is going to go down, ceteris paribus. Now, of course, again, ceteris paribus almost never happens in the marketplace because so many things are indeed moving and changing, at any given moment in time and on any given day, but it's still really helpful to kind of peel back. All right, if I was in a vacuum and this was happening, like, how would I understand the relationship between the two variables in question? In this case, volatility and extrinsic value. They're going to move together. So in other words, when implied volatility goes up, option prices go up, and they go up because extrinsic value goes up. When implied volatility goes down, option prices go down, and they go down because extrinsic value goes down. Now, before we get to the key to understand why this is the case, let me point out one additional thing before we kind of, veer off the reservation. And there's a reasonable chance, maybe 70 to 80 delta, that I forget to bring this up. Just like yesterday, we talked about how more time means means a higher option price because more extrinsic value. Less time means a lower option price because of less extrinsic value. I pointed out, hey, when you're thinking about more time, higher option prices, that's kind of something that you want to utilize on order entry. When you're thinking about less time, lower option prices, that's kind of something that you want to view or analyze, or at least kind of have on the radar over a position's life. Okay. The same thing is actually applying here too. With implied volatility, when you have implied volatility on the rise, right? We are high volatility premium sellers. We are high probability traders. This is going to be something that's going to be of utmost importance to you on order entry. So the simple fact that implied volatility does indeed, lift extrinsic value, that's going to be helpful for you to understand on order entry as you're screening the Tasty Default watch list, you're screening Tom's watch list, you're doing whatever to find your next trade. This is something you're going to be looking at. You're typically going to be looking at this through the lens of like an implied volatility rank, or maybe even an implied volatility percentile. But essentially, you're going to be looking for opportunities where implied volatility has risen, which will then cause the extrinsic value to rise, which gives you a greater opportunity on order entry. Okay. Similarly, the dropping volatility, the decreasing implied volatility, this is going to be something that's going to be on your radar over the life of a position. So while I'm in the trade, like during the duration of this position from start to finish, this is essentially what I want to be on the lookout for. Because again, as premium sellers, as high volatility premium sellers, we are going to benefit from extrinsic values going down. Well, what is one of the things that's going to lead to extrinsic values going down, or that's going to cause extrinsic values to drop? It's going to be implied volatility moving lower. It's going to be volatility contracting. So if volatility does contract, that essentially, kind of allows us to potentially manage our positions for a profit and, kind of earn a nice return on a given trade or a given position, whatever it might be. So similar to what we saw yesterday, I kind of wanted to point out the parallel with, more time, higher option prices. That's kind of a trade entry thing. Lower time, or less time, I should say, lower option prices, that's kind of a trade management type of thing. Same thing with volatility here. So you have the same core relationship for reasons we're going to get into here in a second. But when you're thinking about trade entry versus trade management, think about higher implied volatility on trade entry and lower implied volatility over the course of a trade. Okay. Why do we have this relationship? Well, yesterday we started by kind of unpacking this relationship between the long side and the short side, right? And to remember, hey, the long side buys the contract from the short side. So it is quite literally a transaction. The long buys from the short sells to the long. It is so helpful to think about a lot of the relationships that you can, analyze and uncover in the world of trading or in the world of options specifically, if you trace it back to that basic relationship between the long side and the short side. And the same thing is true here. So with volatility, right? Remember, as we get to our second key here, and I know that my overachievers, man, you guys have already digested the slide. You've read the green box. You've probably already clicked off at this point. And my hat's off to you if you have indeed done that. But for those of us that are still here, us mere peasants, key number 2, remember, the short is taking all the risk, right? The short side of the contract is taking all the risk. And so if you have a contract, a strike, a stock, whatever metric of the contract that might be leading to the higher implied volatility, it's normally going to be driven by the stock itself, but that's not the only thing that drives the higher implied volatility. If you have a more volatile instrument, all other things being equal, then naturally the short side is going to say, hey, I will sell you this contract, but it's going to cost you more. Like, I'll gladly, maybe not so gladly, but I will willingly sell you this contract, but it's going to cost you more because I'm taking more risk. And the reason why I'm taking more risk is because, remember, volatility at the core, what does it mean? Like, what does it represent? It means greater fluctuations. It means greater potential for bigger moves, right? It means you could essentially have an explosive move in the underlying stock one way or another. Well, remember, at the core of an option transaction, what do we have? We have long side, we have short side. Okay, one step further, what do we have? We have long side, limited risk. We have short side, essentially unlimited risk. So no matter what happens, if the long side doesn't like it, he or she can just walk away from the contract. They'll lose the premium that they pay, and then that's going to be that. But the short side is not going to be so lucky. The short side does not necessarily have the flexibility to just walk away from the contract with essentially a limited loss. That's not the way that options work. Now, of course, you can do different strategies and define risk and all those things, and we'll get to all those things down the road, I'm sure. But right now, just understanding the base relationship between the long and the short and remembering, hey, the short side's taking all the risk. It's really helpful here because if you have a higher volatility instrument, then you are by definition going to have more risk that the short side has to now has to command, more risk that the short side has to absorb. And so what is he going to do? He's going to sell the option for a higher price. He's going to raise the cost of doing business with him or her on that option contract because of the higher volatility, because the potential for a huge loss that he would be on the hook on, that he would be on the hook for, I should say, is now indeed greater because the volatility is higher. So that is why the higher volatility leads to more extrinsic value relationship essentially exists. So this is, or was, since it's now in the past tense, the second factor that is driving extrinsic value. So John, go ahead and bring us into the market now. Man, we did it 2 days in a row. Man, I can't believe that. And today we are going to finish our series on a deep dive into extrinsic value. So Josh, let's go ahead and get that guy going. So these are the 3 drivers to extrinsic value. We've been doing this for the last few days. This is going to be the final installment of this series because, again, remember, as premium sellers, like, this is the thing. This is the thing that we're selling in the marketplace. This is, in my opinion, the most important element, or one of the most important elements to what it is that we do. So we did part 1. We talked about time. We did part 2. We talked about volatility. And here we go with part 3. So Josh, go ahead and kick us, get us into the slide, I should say. So this is going to be driver number 3. So driver number 3 is going to be the proximity effect. So when you start thinking about what are the things that impact and influence extrinsic value, right? At the end of the day, we talked about time. We talked about volatility. In my opinion, those 2 are pretty simple. Those 2 are pretty straightforward indeed. This last one, driver number 3, this is where the rubber really hits the road. This is where it begins to get a bit more challenging to kind of understand, like, why this impact is driving extrinsic value and what is the root cause of what's happening here. So ceteris paribus, the closer an option is to at the money, the higher its extrinsic value. Now, most people, when they start trading options, most people, when they begin kind of selling premium or even buying premium for that matter, this is kind of a textbook definition. This is kind of something that you pick up in like an options 101 class, or not even like in an options 101 class. This is in like the, like the prereq to options 101. It's like, yeah, at the money options have the greatest extrinsic value, right? Well, when we dig a little bit deeper, and we go an extra layer or two down beneath the surface, we begin to learn some really interesting things that can help us on order entry and also over the life of a position. Simply put, the proximity effect, which is my own term, by the way, if you Google proximity effect, it's not really going to help you. It's just going to bring you right back to a live feed of what is happening right here. But it makes the most sense, in my opinion, to describe what's happening. The relationship between the stock price and the strike price, that relationship, so that distance, I should say, that has an incredibly powerful effect on what the extrinsic value is going to be for a given option. Case in point, if you have an option that is slightly out of the money, because remember, we're premium sellers, we're high probability premium sellers. So we're going to focus primarily on out of the money options. So it makes the most sense for us to begin our analysis focusing on out of the money options. If you are slightly, but maybe one or two strikes away, you're going to have a very strong proximity effect. Like the proximity effect is going to be very, very strong, putting a lot of pressure on the extrinsic value to be higher. And the reason why that is the case, let's actually skip down to the key right now because I think it'll be really, really helpful. All the risk, because remember, all the risk in an options transaction, all the risk in that little, contract between the long side and the short side, it rests with the short side. Well, we talked about this in installment number 1. We talked about this in installment number 2. And here it is again in installment number 3. All the risk is with the short side. Okay. If we go one step further, though, if we go one layer beneath the surface, all that risk doesn't really kick in until the option goes in the money. Now, that doesn't mean you're guaranteed to make money if the option stays out of the money. That doesn't mean that you're not going to have to suffer some, negative P&L swings even when the options are out of the money. All those things are true. But when we start talking about the catastrophic risk, when we start talking about the big outlier risk, none of that is going to happen until the option goes in the money. Okay. Well, think about an option that is slightly out of the money. Again, just think one or two strikes. Where does that guy sit from a risk standpoint to the short side? It's on the higher end. It's on the higher end because there's not that much room. There's not that much buffer between where the stock price is now and where the strike price is on the option because it is only slightly out of the money. And so when the option is slightly out of the money, as opposed to further out of the money, which we're going to talk about here in a second, the extrinsic value is higher because the short has to charge more for that option because he or she is taking more risk. And to be compensated for that additional risk, you're going to see a higher extrinsic value from that stronger proximity effect. Okay. What if you have a further out of the money option, which is what we alluded to a second ago? Okay, here you're going to have a weaker proximity effect. Here you're going to have a weaker proximity effect, which is going to put downward pressure on the extrinsic value. And why is that the case? Well, again, just think about the risk standpoint. Think about the potential for the option going in the money. It's much, much lower. It's much, much less because you have so much room between where the stock price is now and where the strike price is on the option because it is now further out of the money. And so the proximity effect, in my opinion, and the way that we described it here today helps to really kind of wrap your mind around that relationship between the stock price and the strike price in the Black-Scholes option pricing model. Because again, remember, and we kicked this off in the very beginning of installment number 1 just a couple of days ago, or if you're on YouTube, just a couple of minutes ago. The Black-Scholes option pricing model is controlling all of the pricing metrics and all of the mechanics for determining extrinsic value, intrinsic value, and all those things. We talked about time. We talked about volatility. The proximity effect is capturing that relationship between the stock price and the strike price, which you see right there smack dab in the center of the Black-Scholes option pricing model, or really any option pricing model for that matter, because the Black-Scholes, while it's the most popular and it's the most widely used, it's not the only one. And so again, if you go back to, time, volatility, proximity effect, if you just think about the base relationship between the long side and the short side, it's going to serve you very, very well for understanding proximity effect. One final point, because we kind of talked about this a little bit with, trade, with time and with volatility. What about trade entry? What about over the life of the trade? Well, both of these relationships that you see on the slide, the strong proximity effect, the weak proximity effect, I mean, they can both really be applied to trade entry or over the life of a trade. But again, if you think about the simple fact that, man, it's been said before, and I don't know who said this, but it's pretty good. For every gimme, there's a gotcha. That's exactly what's happening here, right? If I'm going to sell options, if I'm going to sell premium, right? If I sell an option that's only slightly out of the money, I'm going to collect more for that option. But again, I am now on the razor's edge of potentially having that option move in the money, which is where all the risk kicks in. If I sell a further out of the money option, I'm going to have a lot more buffer. I'm going to have a higher probability, but I'm going to collect less because there's lower risk. So on trade entry, you could apply either one of those. Over the life of a position, you can again use both of these relationships, and they help to, describe and kind of pinpoint why your P&L might be changing when it's changing, right? Like if you sell an option that's out of the money, let's say you sell a 30 delta put or a 20 delta put or whatever. If the stock moves such that the put is now closer to at the money, right, it's going to be picking up a stronger proximity effect. The proximity effect on the option is going to be increasing. So the extrinsic value is going to be increasing. So what is that going to do to your P&L? It's going to go down. Because again, remember, if I'm selling an option up here, I want to buy it back down here. I don't want it to go even higher. I don't want to sell it here and buy it back up there. That's not my objective at all. Similarly, if I sell an option, 30 delta, 25 delta, whatever, and the stock moves such that the option is now further out of the money, this is where you're going to see the option price fall. You're going to see the option price fall, at least for one reason, is a weaker proximity effect. Now, again, remember, there's all kinds of things happening in the market. It's always a myriad of different factors that are impacting the options price. But this is how to understand the proximity effect, whether it be trade entry, whether it be over the duration of a trade, or whatever it might be. Time, volatility, and the proximity effect, those are the three main factors driving extrinsic value.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.